Hi, everyone, and thank you, Sergio, for being here. I mean, we have 20 minutes to basically talk about everything. So we have to start fast. Thank you, everyone, for joining us. I mean, the macroeconomy, and we're listening to a panel, is all over the place at the moment. Do you worry that things will be even more volatile, Sergio, for what they've been so far?
Well, everything can happen, of course. We are still missing a major escalation of the geopolitical events. But having said that, if I look at what happened in Ukraine, what's happening right now in the Middle East, then it's quite, it's already quite challenging. So I'm relieved that at the very least the situation between China and the US is calming down, and at this stage we just don't need something else coming, for sure.
Are you confident actually that the US-China relationship will get better?
No, I'm not confident because I'm not in control of that. But what I know is that the world cannot afford an escalation, and most likely both countries cannot really afford some things to escalate in terms of economic consequences. I mean, the situation in both countries is fragile, and I guess a geopolitical escalation is not going to be in the interest of both countries.
What does that mean for the economy, the uncertainties in the economy and interest rates, and how central banks view the future?
Well, central banks seems to also have a very little visibility about what's happening. You see the stop and go approach on rates. I think that the last round was a sensible pose, but having said that, when I look at, from our standpoint of view, my standpoint of view, when I look at the language, I'm not so sure it's over. And I'm not so sure they really believe rates have peaked. I personally think that I'm more in the camp of high for longer than higher for longer. But I don't see how we can bring back inflation at target. Everybody focuses very much on the big drop, but the truth of the matter is that inflation is well above target rates across the globe, and is much stickier than we think. So I don't see how you can bring back inflation without creating an economic downturn. We start to see it now clearly in Europe, and most possibly also in the US soon. So
if you have interest rates high for longer, and there's an economic downturn, what breaks? Is it companies defaulting? Is it commercial real estate? Are there other pockets in the market that you worry about?
Look, I would say that companies, the vast majority of the companies are well placed in terms of capital position. I'm not so concerned at this stage about the private sector. There are, and if you want to look at major events, right, black swan events or things that can really go wrong, history tells us that they usually come from government or real estate. So I think that while we look at the private sector, I think that the reality is that the most fragile parts of the equation, if I look at the real estate, commercial real estate markets across the world, the post-COVID positive momentum was very short. So, and now the reality is that we see that COVID has changed the way people work. People use offices, and we see it as we speak that that one has to be watched carefully.
But commercial real estate, I mean, we talk about it so often, and it's been telegraphed so much, that surely a lot of the positions are starting to be unwound. Or starting to be unwound. That, I mean, if you talk about it as being a big event.
Right. But also there is another element, because more and more also on commercial real estate, if you don't have buildings that are up to the newest ESG standard or climate protection standards, you really have a trouble to rent it, no matter at what price you want to do it. So I think that there is also a, rightly so in my point of view, a push for making sure that we create a more sustainable kind of a landscape in terms of real estates. And so there is a double whammy. less demand, and if there is demand, is very specific on new buildings or refurbished business buildings that have the quality standards and the sustainability standards necessary.
Sergio, you probably have the hardest actually job in banking right now because you're flying a plane whilst building a plane, right? Because you also have to deal with Credit Suisse. How much time do you spend on each?
Well, the first 100 days was at 90% on the integration. Right now it's coming down, but it's still very substantial. I don't expect this to change dramatically from kind of 2/3, 1/3. But it's true that, what I need to pay attention, and we need to pay attention, that clients, we spoke about the macroeconomic conditions, everything that goes on. We need to continue to stay close to clients. We need to run the business. There is a day-to-day business, there is an integration business, and as we speak, we also see a lot of changes affecting our economies and our way, the way we operate as a bank. Digitalization, technology, artificial intelligence is changing the way we're going to work in the next 3 to 5 years. So the real challenge right now for us is not to be stuck into integrating the bank using the model we had in the last 5 years or we have today, but rather also thinking how it's going to be in 3 to 5 years' time. So I can't, and all of us in the bank cannot afford to be distracted from the clients and from a forward-looking aspect of what we need to do.
Do you think client behavior is changing?
Client behavior in respect of...
Just in general, because of the fintech, because of their expectations and their relationship with their...
No, at this stage I don't see it. It's an evolution. Usually the expectations of in general, the market and everybody about how fast the technology really changes the business is overestimated, but the impact over the long run is underestimated. No, the only thing that I saw really changing in clients' dynamics and is really more on the asset allocation side. These higher rates have shifted the asset allocation thinking of clients back to a more traditional heavy component on bonds, basically people are saying with 6.5% kind of yield, 7% even with pretty good quality, do I really need to have risks? And that has changed. And but it's a reflection of both risk aversion, but also the attractiveness of fixed income in the asset allocation.
How much are you focusing on Asia?
Well, Asia is still, a fantastic growing story for us for the last 20 years. It's going to be for the next 20 to 30 years. We are in 13 countries here. We are in Singapore today. We employ 5,000 people in Singapore, the two banks combined. So we are managing 650 billions of assets, clients' assets. So it's growing. So wealth creation is in this side of the world, and then the underlying trends supporting wealth management are intact, particularly in this region. So we need to continue to look at way to lever that, and the momentum is good. Although I have to say that, of course, when you come here now compared to 4 or 5 years ago, you see some convergence to what we see in Europe and the US in terms of economic developments, uncertainties, and coming from different fronts. So.
Sergio, you've also had a good 24 hours because of the AT1s, right? UBS is back in AT1s, and the demand for that was pretty incredible.
Yeah, that I have to say that we were very pleased. I'm very pleased to see that. Now, of course, you never want to come out with any new issue that is not performing, but I would say it's probably one of the highlights that we saw in the last 7 months, because in a sense is creating $36 billion of demand for an instrument and a situation in which, until very recently, people would say the AT1 market is no longer an investable market, or for sure not for a Swiss bank. Actually creating a record demand for the instrument. It's a testament of the confidence not only in UBS, but I do think also to the fact that to the Swiss system, to the Swiss financial systems. And people are slowly but surely recognizing that that event in March was an idiosyncratic event. And the necessity to trigger whatever needed to be triggered was inevitable.
So do you think that that means that actually the trend, the appetite for AT1s will continue?
Well,
I mean,
looks like if I look at the kind of demand we got, I do think that people understand that the AT1 is a very important element of our capital stack, and of course we have the credibility to continue to use it, and it's very good because we are accommodating a big demand for semi-fixed, hybrid fixed income, but at the same time it's very beneficial to our shareholders because this is loss-absorbing capital that has a very attractive terms in terms on a pre-tax, on an after-tax basis, sorry, in terms of cost of capital. So it's a very efficient way for us to, recalibrate our capital base.
So how do you view the banking sector as a whole? I mean, can European banks really challenge Wall Street?
But look, I think that in general, I would say that in certain areas of the business is not advisable to try to compete with the incumbent players who are by now very dominant. If you do so, you have to be very focused, like we do in wealth management, where we are a global leader. We manage 3.7 trillion of assets. We are not the largest in the US, but we still manage a big chunk, 1.7 trillion is US clients. So we see a lot of growth potentials in the US. If you think about only a few years ago, there was 12,000 people with more than 100 million in assets. Right now we have 36,000, so in 5-6 years. So the market is growing. So if you want to compete in those segments, and if you have the capabilities, yes. In broader banking, commercial banking and universal banking is not advisable.
But who do you see as your greatest competitor in wealth management?
Well, I think that the incumbent local competitors are known. So the big names, they are all quite present. Our differentiating factors is that we are probably the only one who has a truly global reach in being an important player, not only in the US, but also #1 in Latin America, #1 by far in Asia, #1 in Europe, and in Switzerland. So we try to differentiate ourselves. We are more, I would say, horizontal in the way we cover the sector, and our US peers are much more US-centric.
How do you see regulation developing, actually, for global banks?
Excuse me?
Regulation, how do you see it developing?
Well, regulations, of course, there is, first of all, the finalization of Basel III is something that we knew, we anticipated. That's the reason why, for example, for us, it's going to increase our capital requirements by maximum 5%. So it's okay, and actually is good that we finalize the implementation of this so that we can create a true level playing field. I'm glad to see that the aftermath of what happened in March haven't come to the conclusion that we need more capital or liquidity. If you look at what happened in the regional banks in the US, it is clear that the same regulation or a big chunk of the regulation that is applied to larger institutions should be applied to big banks. Particularly if you talk about 250 to 300 billions of balance sheet, you should have a little bit more advanced methodologies in the way you manage treasuries than the one we saw. And in fact, the larger banks, the G-SIFI banks, were a safe haven, except one, which had a very idiosyncratic problem. So we don't need more capital, we don't need more liquidity requirement per se, but we need to recognize that A run on a bank nowadays is much different than it was 5, 10 years ago. In very few seconds, you can move out money from the bank. And so we need to take in account how we calibrate liquidity requirements, but also how we make the balance sheet of banks more eligible for access to the central bank window, so that in case of an emergency, there is at least a larger buffer of liquidity available to sustain a crisis.
But do you see, for example, regulators asking for a different base of depositors to avoid basically a bank run on mobile?
Well, that's not so easy because, yes, I think that more than a different base of depositor, a different tiering of the deposits in terms of maturity. That's something that we always try to do, but it's not yet the end of the problem, because if a bank is under stress, as those deposits are rolling off, you're still going to have the same problem. So it's very important to make sure that the quality of the assets is good enough to make them eligible to the central bank window. And that in itself is going to stabilize a crisis. It's not going to resolve a business model issue of a bank, but at least it can avoid conflicts or contagions in the rest of the system. So that's the biggest lesson learned from the crisis in April.
Sergio, when you look at the integration, I mean, it's hard because a lot of it, you rely a lot on talented bankers, and with that goes culture. So in these big integrations, it's always been culture in the past that's been a problem. How do you deal with that?
Well, look, we are onboarding the new colleagues of CS with the right spirit. I don't think that per se there is a cultural clash between the two organizations. We have been competing very fiercely, but basically more or less with the same business model. What is helping us is that, of course, this is a UBS-led acquisition. Processes, policies, risk management approaches are UBS. So we just clarified this matter in a way that, in my point of view, avoids, potential conflicts. So, of course, in some cases, it's not easy. We are not trying to say that we are per se always the better solution, but it's the fastest and the one that guarantees also in respect of onboarding and understanding each other, how we operate. If we try to debate too much on what is the best way of doing business, we would not only delay the integration, but also potentially create some clashes.
I know that a lot of people in the audience are chief executives that have to deal with the talent and people they hire. You spent $500 million on talent retention. How do you choose who you keep?
Well, look, first of all, if you look at in the big scheme of, in any M&A, not only in banking, usually there are retention that in many cases, in our case, is going through also in order to make sure that enough people are staying to guarantee the well-functioning of the banks. Because as we speak, and I'm talking about functions like in risk management, in compliance, in finance, and not only for producers. So people think that we are talking about producers, but in effect, what we need to do is to make sure we continue to have operational stability. It's very important. We are still running 2 G-SIFIs. It's, UBS as an holding, but we have 2 systemic relevant institutions, financial institutions, up and running. So we need to make sure that we are fulfilling regulatory requirements and the expectation of clients. So that's a good investment that allow us then to create value over time.
But you've also moved some $5 billion in wealth management assets to the wind down unit, right? Like a bad bank. How do you choose what goes in that?
Well, the vast majority was, to be honest, already pre-selected by Credit Suisse. So what we put on top of it are some businesses or relationships that we felt were not in line with our policies and guidance, but the vast majority was containing and defining the perimeter, which we did as of the end of September, and start the execution. Actually, since we took on de facto the management, and in April, we took down the non-core assets by 30%. And another 50% of what is left as we speak is going to run off naturally. But we clearly going to accelerate that runoff in the next few quarters and years.
Sergio, what does your chairman think of you being called the George Clooney of Paradeplatz, which is true?
What he thinks?
Yeah, what does he think?
I don't know what he thinks, but he reminds me all the time, and he reminds everybody I meet, so that I started to tell him, if I'm George Clooney, you are Marlon Brando, and he was all happy about that. But then I told you, wait a second, I'm talking about the one of The Godfather, not the young one. And so we took it that way. So.
Sergio, thank you so much for joining us today. Thank you.
Thank you.